audience participation time. So first up, these are all based on results out this week. Added to the MICROCAP League this week. Gear for Music, it's at number 100 in the MICROCAP League, ladies and gentlemen. So let's have a look what they do. Oh, I need a particular in there. Gear for Music is an online retailer of musical instruments and music equipment, operating 21 websites in 15 languages. In fact, is anyone here a musician? Has anyone here used them? Let me know. Gear for Music is one of the largest retailers of musical instruments and music equipment in the UK. COVID was time for them, wasn't it? You know, I mean, lockdown. Everyone thought, I know what I'm going to do. I mean, do you know what I used to hate? Seeing people on Instagram and Reels, whatever, would learn the guitar in 3 weeks. Whereas I'd been sitting there eating crisps, looking stocks. But people who actually did something constructive. But that was the time for Gear for Music and Focusrite as well. But anyway, let's look at their website quickly. So Gear for Music, oh, okay, this is the investor site. But our business, they did all this. View our products. Oh, let's look at them. Yeah. They got 64,200 products. Part of me thinks now they got so many products, the margins are thin. But they do everything from bass guitars, amps, sub-zeros, everything. So there we are. Anyway, so if I wouldn't mind watching that video later. The guy drumming. I bought a set of drums once. And literally, I was so keen. I bought a set of drums. Thought I'm going to be a drummer. Drumming's cool. You see the drum, I also drum solos, you know? Break it down. I literally, first week, every day I practice. Second week, about 3 days. Third week, about 1 day. Fourth week, they're back on sale. I was rubbish. Absolutely rubbish. Anyway, let's have a look at the tail of the tape. Gear for Music. 168 is the share price. Target price is 199. Upside, 18.45%, according to the broker. Not a lot there. But sometimes you can ignore that, you know, because we know that that's just an indicative price based on a model of, you know, multiples of PE and sales, whatever, and profits. Sometimes the share price can go a lot higher or a lot lower than that price. So it's just, but it's nice to see what the brokers are saying. It's always good to read broker notes as well and, you know, understand where they're coming from because you educate, you know, educational. They are broker notes. Market cap 35, enterprise value 42. So we know they got a bit of debt because the enterprise value is above that. Net asset value per share. Oh, look at that. 183. That's quite good. So they got, you know, their net assets. If you sold all their drums and their stuff, guitars, all the stock and all that stuff, you get more for the company than it's valued at now. So average daily volume, not very high, £27,000. Revenue, 144 million. What? So I'm thinking now, the margins are quite thin then. Operating profit, they're making a profit though, 2.7 million. Cash, 4.6. All right, debt, 12. Operating cash flow, 14. Free cash flow, 10. Okay. So scores here on the doors. Growth is 12, is okay. Value is 20, is good. Momentum, it's okay. Maybe it's getting there. Health is okay. Efficiency low. Potential low. So that's where it's not scoring. So these were full-year results to 31st of March. Top line down 5%. Operating profit growth, though, up. I'm assuming since COVID, some of these companies, again, they've had, you know, a bumper time. Next time we have a pandemic, guys, in 100 years' time, right, guys and gals, I don't want to say that phrase because it's associated with someone very questionable. But ladies and gentlemen, next time we have a pandemic, we know the stocks get into, you know, when you have to be locked down, things like this, you know, people at home doing stuff, playing guitars. Anyway, so operating cash flow is going down. Value is good. Price to sales 0.2. Inside the PE though, 54. Price to book is good. EBITDA, that's fine. 6. And price for cash flow. So health, it's got net debt of 7.3 million. So that means if you add the debt and the cash, you know, together, you end up with debt rather than cash. Growth scheme is okay, but they can cover their current liabilities. That's liabilities due within 12 months. So health is not too bad. Again, margins, efficiency, 27% gross, thin. It's wafer thin. They have improved since last year. That they make a loss last year. They've had to resize and restructure the business, I assume, after a COVID boom. But it's in a bit of uptrend, broker target there. That sucks. So they're in EBITDA of 9 million, operating profit 2.7. Okay. Well, let's look at the chart. Let's go to the chart on G4M. Well, look at that. Look at that, COVID. That's Dr. B, and it went from literally 160 to 10 quid. So everyone's at home learning to play the guitar. Yeah, I'm going to be creative. There are all these videos in COVID lockdown. And then, people start sending their kit back. I don't want that, actually. I can't learn to play the guitar. Send their drums back like me. I bought my drum secondhand, though. But you see here, it's starting to sort of try and rally, isn't it? It previously broke out here. We're above the 200-day moving average, pretty much. Above the 50. Oh, we got a golden cross going up. Well, it's a bit of a dip there, so worry. When the share price is below the 50-day, then it'll drag it down, of course. But it did pump on those results. What it got by? 25% on those results. But, let's have a quick look at the forecasts, scrolling forward. So it's not a huge amount of growth top line. They're going 7%, 2%, 2%. Like I said, the margins are improving slightly, not hugely, but you're getting net margin of like 1%, 2%. Remember, a thin margin could end up disappearing, So even though the value's there, I've got 41% over the next 2 years if they achieve that growth. Ladies and gentlemen of the jury, the Watchlist jury, what do you reckon? Watchlist or ignore? Ed says G4M, not for me. Mark, no. Oh, I like that, Mark. No, a bit out of tune for me. Yeah, struck a bum note. Rob, not for me. David's iPhone. Thanks, David's iPhone. Can you tell David to turn up once in a while? David's iPhone is very regular. He's very loyal. But David, never here. Can't see enough growth to come. Value all in the stock they hold, so not for me. Have bought from them for the kids, and they do sell decent products. So that's nice inside information there. But it's not inside information. Just, Mick, not for me. Tim, nah. Patrick, margins too thin. Ignore. Yeah, that's good to see. Have a bit of discipline because even though it's rallied strongly, hopefully someone's got a bit of profit there. It's rallied strongly, but is it all priced in? Gareth says G4M a watch list. It's in a uptrend before the results. Yeah, maybe so. Well, do you know what? To me, I think it's rallied a bit strongly. A little bit of problem with debt, but they are generating cash now, and I think maybe I would see if it can get over that because it's rallied a couple of times there. I said it's come back down. Well, let's see. I think it may settle down. If it comes back to this level here, maybe with a tickle. But like I said, they're not paying a dividend or anything. Margins. If you're going to be picky about it, I'd say I'd watch it. It's almost like I'm an observer. I'm probably never going to invest unless it comes down significantly. But what I'm going to do is ignore it, but watch it. Is it something that we can do? So I'm going to put like a little alert here, and I say add alert on the chart. G4M support, etc. And so maybe where it's come down for that level before, I get notified it comes back down here. And you often find that. Don't worry about fear of missing out. Just put a chart alert on it, and you find that'll take away the fear of missing out because if it comes back down here, value's good, and the steam has come off a little bit, and it should be good to go. If you want to trade it, if it's a chart, long average chart. It's a Viagra graph. Will end quickly. Yes. Blind eye. Yeah. It's a Viagra chart. Yeah, it is. Yeah. Okay, let's move on.